Today is still going backwards in real terms. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and problem news with a distinctively Australian flavour. Well, wages growth accelerated to its fastest rate in a decade at the end of last year, but people's pay packets aren't growing as fast as the Reserve Bank forecasts. And given the strong inflation last month at 8.4% annualised, pay continues to retreat in real terms. So we're all getting poorer. The season-adjusted wage price index rose 0.8% in December quarter 2022 and 3.3% annually, according to the latest data from the ABS released today. They said the increase in hourly wage rates for the December 2022 quarter was lower than the increase for the September quarter, 0.8% compared to 1.1%. It was, however, higher than any December quarter increase across the last decade. That follows on from the September and June 2022 quarters, which were also higher than their comparable quarters back to 2012. In combination, these quarterly increases have resulted in the highest annual growth in hourly wages since December 2012. Private wage sector growth was 0.8%, and that was slightly higher than the public sector at 0.7%. However, consistent with the September quarter 2022, annual wage growth in the private sector was 3.6%, and that's remained significantly higher than the public sector at 2.5%. The proportion of private sector jobs recording wage increases in December also was 21%, which was lower than the 23% from the same quarter in the previous year. And the average hourly wage change for this subset of jobs was 4%, notably higher than the 2.8% recorded in the same quarter in 2021. And by the way, in original terms, quarterly wage growth across industries was highest in the accommodation and food services industry at 1.7% and lowest in the administrative and support services industry at 0.3%. Annual wage growth was highest in the wholesale trade industry at 4.2%. That's the highest growth since December 2012. And the education and training industry recorded the lowest annual growth rate of wages at 2.4%. The figures were weaker than market expectations, which were for wages to increase about 1% in the final 3 months of last year and by 3.5% annually. An increase in hospitality, aviation and tourist wages did provide a modest bump to the headline growth number due to the deferral of award wage increases for those sectors from July to October. And workers in the accommodation and food service industry did receive the largest pay rise in December, recording an average wage increase of 1.7%. So while wages growth has picked up sharply over the past year, high inflation means workers continue to go backwards in real terms. In its latest statement on monetary policy released earlier in the month, the RBA revised its wage growth forecast higher and warned that high inflation could push workers to make unsustainable pay demands that would embed rapid rates of price growth. The central bank expects wages growth to accelerate to 4.2% by the end of the year, which will be among the fastest rates of increase since records began in 1997. BetaShares chief economist David Bassenet said that the latest wages data is not strong enough to justify the RBA delivering a supersized 0.5 percentage point rate rise in March, which it had considered at the recent board meetings. The good news for workers is that wage growth is picking up. The good news for the RBA is that the acceleration in wages growth remains reasonably modest and is not yet at a pace inconsistent with its long-run 2 to 3% inflation target, he said. And BIS Oxford Economics head of macroeconomic forecasting, Sean Langcake, said he still expects the RBA to deliver 3 additional rate hikes. Today's data is below expectations, showing the breakout in wages growth is not as bad as the RBA had feared so far. Nevertheless, the labour market continues to track in a very tight position, he said. The WPI is a narrow measure of wages growth, and this data will not completely allay the RBA's concerns over a wage price spiral. Investors expect interest rates to peak at 4.3% in September after the RBA's latest minutes revealed the board was so concerned about persistently high inflation that it did not even consider holding rates steady at its February meeting and instead contemplated a supersized 0.5 percentage point increase. RBA Governor Philip Lowe has previously said that if salary increases above 4% became common, it would be difficult to engineer a return to the central bank's target inflation band of between 2 and 3%. But even so, the bottom line is this: we're all getting poorer in real terms because the inflation is eroding our spending capacity, and if that doesn't crimp spending and also put more downward pressure in terms of consumer confidence, I'm not sure what else will. But I'd also make the point, of course, that some people have been fortunate enough to switch jobs and gain quite significant increases in pay, sometimes more than 10%, whereas others, particularly in the public sector, seem to be locked into this very low spiral. And given the tightness of government budgets, I have to say that I think public sector wage growth will remain very, very low, which essentially means people are earning less in real terms relative to their expenditure, so they'll have to crimp and save. This is not a good look, but unfortunately, it is the nature of the beast at the moment. This is Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.